Coming up today, economic data comes in hot, causing a bump up in bond yields. Is Nvidia bubble? A look at market positioning, a pullback in commodities, China surrounds Taiwan, Ethereum ETFs on the way, and the dreaded bear signal for the stock market. And a warm welcome back everybody to your favourite finance channel. I'm your host Jared, and every day after market I make these videos to inform you of all the most important financial news, data and events happening across markets today. So if you haven't already, think about hitting that subscribe button, and a big shout out to my regulars who continually support independent financial journalism like this channel here, where I can freely speak my mind, unlike the elitist agenda that's pushed to you on mainstream media outlets. And what an interesting day on Wall Street it was. On the back of Nvidia's blowout earnings, market gapped up, but also prior to open, we got the most important economic data this week, Purchasing Managers Index, the PMIs, with both manufacturing and especially services coming in pretty hot there, 54.8 versus 51 expected, and that caused the market to immediately sell off and finish the day near the lows. On quite a lot of bearish breadth, we can see the pullback across the market now. S&P Qs, Russell, all underneath a 5-day moving average, and even got some sectors now like energy and discretionary underneath a 50-day. All other sectors pulling back up the front except for semiconductors thanks to Nvidia. And now with a 2-year bond yield back to uptrending across the board, and that appears to be what the market's reacting to today. Kind of put Nvidia's blockbuster result on the sidelines and is focused on this hot economic data, and the market is repricing its chances of the Fed cutting rates anytime soon. As we can see in Fed Fund futures, had previously been pricing in only days ago, 2/3 chance they're going to cut in September, and once again this trend this year, push it out, and it's just pushed it out again to the November meeting, which comes 2 days after the US presidential election. So now the market's only pricing in one rate cut this year, and I'd say there's a very good chance that we get no cuts at all. And it wasn't just the PMIs in America, also the Eurozone accelerating, pointing to fresh signs of global growth coming back. And that's been a trend for the last 6 months, looking at the Eurozone, United Kingdom, United States, kind of all been drifting upwards here, looking at the PMIs. And there's been a flurry of Fed officials speaking this week. Up to us, market observers, to listen to dozens of them, trying to decipher where they're going. Quite oftentimes, they can be at other ends of the spectrum. Coming in more on the hawkish side is Atlanta Fed Reserve President Raphael Bostic expects to hold interest rates steady for the long haul, noting that a return to the central bank's 2% annual inflation target could be a way off. Pouring some cold water on the recent tone of Jay Powell, still talking about cutting rates soon. And so it seems the market's taking a bit of a turn here with those yields turning back up, repricing the chances of Fed rate cuts. We can see that in today's market heat map. Quite bearish across the board, with just a handful of market leaders finishing the day higher. Nvidia, General Electric and Eli Lilly showing up green in an otherwise sea of red. And that's what gave us today the dreaded bear signal of the bearish engulfing candle. That's when we open higher above yesterday's high, then we close lower below yesterday's low, and this candle engulfs the previous candle. And in my studies, bullish and bearish engulfing candles are one of the most high probability candlestick patterns there are. And just looking back in recent history, we did get a bearish engulfing candle in the S&P back on the 4th of April, which then went on to consolidate for a few days, like they often do. Then the market fell over a little bit before finding its footing. Prior to that, we also got a bearish engulfing candle on the 27th of July, 2023, and that actually went on to a much bigger correction in the market, bit over 10% pullback over the next 3 months. And prior to that, we got a bit of a bearish engulfing candle in April 2022, and that too led to more weakness in the market in the months ahead. So up until today, I thought the market would be going on a parabolic rip here, exacerbated by Nvidia's earnings. However, like I always say, you've got to pay attention to the tape. Technicals lead, fundamentals follow. And so I'm going back to my previous thoughts, a bit over a week ago, when I thought the market would find new all-time highs. Then like we often see when markets hit new all highs, they can stall out and consolidate, and that's what I think we're in for here now. I'd be very surprised if we traded back down to 5,000. We've got a lot of supportive things happening in this market. However, we could consolidate between 5150 and 5,300 for a little while here. And just looking across at other markets, volatility too put in a bullish engulfing candle. However, given the relatively sharp sell-off we had across the stock market today, still pretty subdued here on a 12 handle. Be a lot different story if it spiked up to 15 or 16 or so. Option dealers still asking less than 2 points of premium and implied volatility above realized. And so the S&P only fell 0.73% today, even though it looks a lot bigger on the chart as we haven't had a 2% move. And over 300 days, it was really Nvidia holding up the index, because looking at the equal weight S&P 500, We're down 1.4%, and looking at an even more broader index, the Russell 2000, down 1.6% today, a bit above average volume as well. And there's a look at Nvidia. Like I said, we're looking for that close above the big psychological level of $1,000 to technically confirm it as a breakout. Looks like we got that here today. However, there was a bit of a pullback in the afternoon in tandem with the market. Still managed to put in a green candle, close above where it opened, and finished up 9.3% today. Pretty good result considering it was a really weak tape across the board. However, that price action in Nvidia didn't carry across the whole semi sector today, putting in a little bit of a dark cloud cover type formation here. As looking at other semi stocks like AMD, also did a bearish engulfing. Nothing too exciting from ARM. Supermicro Computer actually finished down 3%, and Intel took it on the chin again, down 4.2% in this strong downtrend that it's now in. And so it's no surprise that Nvidia finished higher today. Not only did they blow it out of the park with their revenue and earnings growth year over year, exceeding even the lofty expectations set by Wall Street, they also boosted their dividend and announced a 10-for-1 stock split, all of which gets the algos pumping the stock and is keeping Wall Street excited about that AI narrative led by Nvidia. They're looking at a little commentary from some Wall Street banks on the back of their earnings report. Goldman Sachs said new products to drive sustained growth in data center. JP Morgan, demand continues to outstrip supply into calendar year 25. Bank of America now sees $50 plus in earnings per share within 2 years. And finally, the perma bull, Wedbush, even went as far to say the AI revolution is just getting started. So a lot of people are wondering, is Nvidia in a bubble? Is it just like Cisco in the late 90s? Given it's had a similar huge and crazy run up in its stock price. Well, it's interesting because looking back in history, no stock has sustained the huge run up in the stock price like Nvidia has. Competitors have always come and eaten away, and whenever a company's had wide gross product margin, just like Nvidia's got at the moment. So it's almost guaranteed competition will catch up. However, that could still be 2 or 3 years away. And just looking at Nvidia's valuation of its 3-year median next 12 months price to earnings ratio, it's actually trading cheaper than where it was 3 years ago before all this craziness started. The valuation's actually improved a lot over the last 9 months. And my stock fair value indicator, which looks at a lot of things, balance sheet items, future growth, etc., it's got fair value around 834. However, I'd say it deserves a premium given its dominance and brand leadership. And so I'd say at $1,000 a share, given its current growth rates and where we're at right now, one could argue it's somewhere around fair value. However, technically speaking, look at the long-term monthly chart, it's hard to make a case that it's cheap here. And because of competition coming over the next year or two, likely to eat away at their margins, we could potentially be closer to a top than a bottom. But like I said, we just need to trade above $1,200 a share, and it's the biggest company in the world. So I still think that's possible this year. And who knows, we can't rule out the possibility of $1,500 a share either. We've also got the permabull Tom Lee from Fundstrat saying a global labor shortage will send tech stocks soaring, with the sector poised to grow 50% of the total stock market. Pretty bold claim indeed. Pretty much saying AI is going to replace millions of workers, and to the victor goes the spoils, those that are owning all the AI technology, hardware and software. And it appears hedge funds are already positioned for what Tom Lee is saying, with their heaviest weight to semiconductors in over 15 years, looking at long US equity portfolios, now approaching 7%. And it's not just tech stocks, which was the big story last year, had a broadening of the rally this year, and a lot of good seasonals and technical signs that we should still finish the year higher from here. Looking back over almost 100 years of data, when the first 98 trading days finishes higher between 10 and 15%, every time that's happened, we've gone on to add on more gains through year end and finish the year higher with healthy double digits. However, if we are up more than 15% at this point in the calendar, that could be considered too hot, and the market can have a bit of a pullback and softer returns for the remainder of the year. And it's not all sediment, liquidity and momentum. There are some strong fundamentals backing the market, including US companies paying out a record $164 billion of dividends in the first quarter, with 97% of them increasing their dividend payments or holding them steady year over year. So corporate profits have bounced back, along with dividend payments and share buybacks. So the return of capital to shareholders still continuing upwards. And liquidity is plenty in this market, not just from the Fed and the Treasury, but also looking at market makers and the top of the book depth and S&P 500 E-mini futures contracts. So that's basically looking at how many contracts are sitting on the bid and the offer as a way to measure liquidity. And that's getting back to 2021 levels. And so you could think of that as the market trading really thick. If liquidity was low, the market's more thin, it can get pushed around more easily, volatility can spike, we get big moves. However, this market is well supported, and we can also see that in dealer S&P 500 spot gamma exposure. So basically, gamma measures the change in option deltas relative to the change in the underlying asset. And to keep it simple, basically where it is at these near record highs is also supportive of the market and creates a thick market. Basically, as the market goes down, Dealers have to buy the dip, add deltas. As the market goes up, dealers have to sell the rip and decrease deltas. So that can be suppressive of volatility and help the market kind of keep trading thick. And this market is very long, looking at non-dealers in US index futures and their positioning, also sitting at highs as well. And with the VIX sitting around 12, that's about 9% on the percent rank, going back to 1990. So in other words, 91% of the time, the VIX is higher than where it is now, and that too is really supportive of the market. Typically, that's associated with good forward returns. So like I said, while I think we may be in for a little bit of softness consolidation here, we may pull back as we often do after engulfing candles, and maybe just hang around the 5,300, 5,200 level on the S&P for a little while. We should still go on to find new highs for the year, hit 5,400, 5,500, and potentially a little higher going into Christmas. However, that's the here and now in an election year. Just stepping back, looking at the holistic picture, just keep in mind, United States stocks are trading above the 90th percentile in terms of PE valuations, 21.4. That means about 95% of the time, looking back in history, United States stocks have been cheaper in terms of how much you're paying for every dollar in earnings. Median somewhere around 16, and since the US stock market makes up 60% of the global stock market, that's bumping up world stock indices and their valuation metrics as well. However, just looking underneath the hood at Japan, Asia Pacific, excluding Japan, Europe, and emerging markets, they're still within their normal ranges of valuations, just sitting a little bit above medians. And don't get me wrong, like I always say, the United States deserves to have a premium. It's pretty much the world's home to capital, leading in innovation, global technologies, regulations more supportive of capitalism, and a lot would argue just the general American work ethic is a lot stronger than that of Europeans. And that's backed up by stats as well, by looking at the amount of vacation days Americans take versus Europeans. Many Americans will only get a couple of days off work a year. However, in other places like Europe, some countries mandate 4 weeks a year in paid holidays and things like that. However, I digress. And I mean no offense to Europeans when I say that either. I'm just looking at stats and a commonly held belief, and potentially one of the reasons why United States has significantly outperformed European stocks over the last 20-30 years. So even though the United States definitely deserves a valuation premium over the rest of the world, even relative to itself, looking back compared to its own valuations, looking at the cumulative change to real profits here in the black line, and whenever you see the word real in financial stats, that means adjusted for inflation, and so it makes it easier to compare things instead of looking at absolute numbers. So looking at the cumulative change in real S&P 500 and real profits, S&P here in the blue line, the only time it was really higher than real profits was back in the late 90s. However, what you'll notice over time is stocks can often stay overvalued or undervalued for an extended period of time. However, they always converge back to profits because that's what stocks and markets do over the long term. They correlate with earnings and profits. And so by no means is the US stock market cheaper. We'd have to see a huge acceleration in profits for these valuations to be justified. And that's why I always say the best way to insulate your portfolio from prolonged bear markets in any one country is to have international exposure. And even though the market is just off all-time highs, what we don't have confirming this breakout is Dow transports. They're actually breaking down. And so this Dow theory was created by Charles Dow, journalist back at the Wall Street Journal over 100 years ago. And he said for a bull market to be confirmed, both the Dow Jones Industrials and Dow Jones Transports have to be breaking out to 52-week highs to confirm all cylinders in the economy are firing. And there's a look at the Dow Jones Industrial, came off a little sharp today. However, looking at the transport sector, that's already been in a downtrend for a couple of months. And so that's one thing, not confirming this current bull market here. And even though we've got a lot of things pointing to us finishing the year higher, these are not the type of headlines you want to see in big financial media outlets as a sign we're in a cheap stock market. Stocks are expensive, why they won't collapse. Now you can pretty much make an argument for anything. And in this article, they're saying the silver lining is that they could easily remain so for a long time, the valuations. And like I showed you, that is true. However, what you'll find in investing, whether it's stocks or bonds, REITs, whatever it is, your starting valuation, your starting yield will correlate strongly what your future average yearly returns are over the next decade. And just looking back at history, the United States, at current valuations, is forecast to deliver pretty much flat returns, not adjusted for inflation over the next decade. What could do better over the next decade, something you guys know I talk about a lot, is commodities. Great portfolio diversifier. And we've had oil pull back again today, potentially reacting to the shift in bond markets as well. However, I'd say it's more continuation from the Biden administration willingness to release more of its strategic reserves to help dampen prices as the states go into the warmer months and driving picks up around key holiday periods. And that spilled over to a lot of the commodity complex today. Pulling back a bit here, so I'm saying it could be an opportunity to buy the dip. However, apart from agricultural commodities, I think the energies and precious metals, hard assets, could have a little bit further to go, while softs look good. And you'll often hear the terminology, hards and softs and commodities. And you can basically think of a hard asset as if you drop it on your foot, it hurts. With a soft one, it won't, something like wheat or corn. However, when the pullback is done, it could be a good buy the dip. Just looking at shipping and container rates back on the march higher, especially now we've got those PMIs in the States and the Eurozone turning back up. China's got signs of bouncing back as well. India's doing well. Global economy had been softening. Now it seems to be kind of moving sideways, maybe ticking up a bit, and that's showing up in shipping rates, which correlate well with commodity prices as well. Let's not also forget we're currently living in the most elevated levels of geopolitical tensions that most of us have in our lifetimes. Markets ignoring it for now. However, that may not always be the case. That's a tail risk that could upset the bullish narrative this year. Still got Russia threatening the West with direct strikes on the British military targets, and with NATO looking to continually inch closer and closer to the Russian border. Doesn't look like this situation is going away anytime soon. And now we've got China holding massive military drills surrounding Taiwan, even labeling it as strong punishment in response to their newly elected president, who's a China hawk and called on China to stop threatening the island and accept the existence of its democracy, something China will never do. As Taiwan was originally a part of China, they share the same blood. However, after decades of breakaway and rebellions, they set up their own democracy, and wouldn't you know it, the people happen to like having a democracy. And China's done these intimidating, threatening drills before. However, this one, it's on a different scale. Just looking back to their August 2022 drill, here in the red squares, you can see where they are surrounding Taiwan. Here we are now, with them in the green, having a bit more of a larger presence. And while this is likely a drill and will dissipate, let's not forget China's president, Xi Jinping, specifically told Biden recently that China does plan to reunify with Taiwan. Some even call it Xi Jinping's signature political move of his career, or to be bring back Taiwan underneath the umbrella of China directly. Something they've repeatedly said they're not willing to negotiate on, and in my opinion, they're going to keep building up an immense amount of military muscle and might surrounding the island, so much so that it deters the West from even trying to step into the arena and fight back. I think the best strategy for the West is to delay that day for as long as possible so we can deleverage from Taiwan and our reliance on them for semiconductor chips, along with China for other key things like rare earth materials, pharmaceuticals, something that's already been going on since COVID anyway. And who knows, maybe we'll wake up one day and these China drills around Taiwan turns out to be the real thing and we're seeing headlines of China going directly into Taiwan. Hopefully that's not for at least another couple of years, and it doesn't really look like there's any way out for Taiwan from this point on. Nonetheless, the market's not really worried about that right now. We've got gold pulling back over 2% today, having a decent pullback after it's been on a pretty good rip the last couple of months. And there's crude as well, losing that support we were watching around 78 a barrel, and copper continuing its pullback after it too had a parabolic rise. But like I said, we've still got agricultural commodities like wheat holding up, corn, orange juice continuing, soybeans slightly finding new highs, and a bit of a bounce back in cocoa. And moving on to crypto, and a surprise change of direction for the industry. Looks like Washington and Congress all of a sudden embracing it now, as it looks like we just got news. The SEC approved filings from the NYSE, NASDAQ, and CBOE requesting a rule change that would enable them to list spot Ethereum ETFs. There's still a bit more of a process ahead with registration statements that need approving, but this looks pretty much like a done deal. And like I said, this was a surprising reversal from what we were just hearing a bit over a week ago. However, it appears the powers that be had a bit of a change of heart and have given the green light for these to go ahead. And I'd say that's got to do with Wall Street having done really well with these Bitcoin ETFs and wanting to gobble up more of the industry for themselves, and making all these products originally designed for their decentralization and being away from the system, as they call it, now being centralized by Wall Street and pretty much owned by the system now. And then another twist, got the House of Representatives passing a bill barring the Federal Reserve from issuing a digital dollar. That's a central bank digital currency. And that's not the B end of it all. It is symbolic though, as the Fed has not put forward plans to issue a CBDC and has repeatedly emphasized that it would not move forward without congressional approval. So it looks like for now, the government and Wall Street are embracing private cryptocurrencies. However, it looks like that could still be a ways off, even if it does happen, especially with Trump, current favorite to take the presidential election in November, has vowed to block the creation of a central bank digital currency and has recently been supportive of Bitcoin, as that is most likely another way to gather some more votes. So those developments look to have originally got the market for Ethereum a little excited. However, it turned back, put in a big spinning doji. A lot of trading though, and Bitcoin still a little bit soft here, probably on a sympathy trade with the pullback in the stock market today. However, if the government and Wall Street's fully behind it, then there's really no telling how high it could go and I'd expect both of them to break out to new all-time highs soon, given that more institutional money is likely to keep flowing into these ETFs, and it could cause another pile-on and big melt up as well. And to be honest, I'm really not sure what to make of crypto here. I didn't think these latest developments were going to materialize the way they did, especially knocking back the central bank digital coin. And I guess we'll be living in a really interesting world if we've got Bitcoin trading at $1 million a coin, and the likes of Michael Saylor and co. become the richest people in the world from simply cornering a portion of a digital market with a finite supply that doesn't actually yield anything and isn't actually used as a real currency. It's pretty much just a pile-on. And I guess maybe I'm old school, as I like my non-fiat hard assets, nice and shiny, that I can hold in my hand and that I also have physical control over, like gold always has been and always will be. And that to me will always be a better form for storing wealth than apparently the new digital gold that is stored in cold storage devices like this here, Ledger. However, they still rely on the internet and a digital network to function for you to be able to access and transfer your wealth. Unlike gold, which you can convert to fiat currency in pretty much every country in the world. Anyway, that's just me. Congrats to all those that have been long crypto. Looks like your belief in it is going to pay off yet again. And just a reminder, the stock market's closed this coming Monday in observance of Memorial Day, and that is to honor those who died while serving the United States with a national holiday tracing its roots back to 1868, kicked off by a group of Civil War veterans who created the day to honour those who passed in war. Looking at the economic calendar, we don't have much to finish off the week, just some durable goods orders tomorrow. Fiat Greed Index back in the neutral zone at 54, and corporate insiders doing a little bit more selling than buying compared to normal levels. And just moving through a few charts, we've got China pulling back as well today, down 2%. Bit of a sharp reversal in clean energy, but it was on low volume. Sizable dip in cannabis, MSOS. Really sensitive to risk sediment here. Looks like we've taken out this support zone, and I'm going to move that down to back to that 750 per unit. See if we can find some support down there. May set up for another good dip buy, as we've just had one at 850. Potentially another one around 750, 760, as I still like the fundamentals in this industry. But as always, it is a massively volatile sector. It's always going to have huge ups and downs for years to come. Bit of a sharp pullback on Apple today. Was looking for it to get up to the mid 190s as a potentially good area to short. May have missed that. And another down day for Tesla, 3.5%. More weakness for discretionary retailers like Nike, Best Buy, whilst the more defensive stuff like Walmart continues to hold up better. And a bit of a sharp turn down in the regionals and financials today. Not liking those high bond yields at all. Alright guys, there we have it for this Thursday session. Big bearish engulfing candle on the S&P 500. Could at least mean we consolidate, maybe pull back a little bit further to 5,200. Especially now with these bond yields creeping back up. Jay Powell, Janet Yellen, really not going to like that after they successfully talked them down from the 1st of May, now done a U-turn, and the bond market saying, not so fast. Economic growth and inflation is still here. And given where we're at now, I'd be very surprised if we did get some rate cuts this year, unless we got a big material spike in the unemployment or some other big surprise that knocks things off a bit. Other than that, any dip in the stock market is probably a good buy the dip opportunity, as like all the stats I showed you, we should still finish the year higher, and at the very least, that's very hard to bet against. Thanks very much for tuning in to the Daily Market Review, and I'll see you again tomorrow for the last trading day of the week. Cheers.